if anything, do you guys know about 1031 exchanges?
So you have, it's like for like. It has to be realistic, like you're trading something for the other. It's the most that I know is that like you can have a realtor help you find things and stuff, but you need an attorney to do some of it.
Right.
So like your realtor can help with finding the property and helping set up title stuff, but
Yeah. So very good.
that it's attorneys to finish it out. Is that a little?
Yeah. So the purpose of the 1031 exchange and 1031, hold on. Just wanted to close my door. And the purpose of 1031 is to defer your capital gains tax that you would pay if you sold an investment property and were realizing a capital gain. So in that example, or with that, if you sold or if you purchased a property for $150,000 and then rented it out for a couple of years and then sold it for $200,000, you have this $50,000 gain. And if under normal circumstances, you would have to pay a capital gains tax on that $50,000 gain. And that's like really a basic example. And that's the gist of a capital gain on investment real estate. Now, what the 1031 exchange is, and that's the actual tax code, the IRS code for what they recognize as this this type of exchange. And so what it allows you to do is defer that capital gains tax into the future. And there's loopholes with it, and different ways to get around it, and yet at its very most basic, the point of this is to defer that tax until the future. And at least in a lot of investment circles, the idea is that by deferring it, you don't know what the circumstances are going to be like in the future, and as long as you're not paying tax now, maybe that's better. Okay. You're right, Beth, in that they say, like, there's some basic criteria around the 1031 exchange, and one is that it needs to be like-kind property. And like everything else with the IRS, or just generally tax code is it's like gray, right? Like it's just not black and white. You can't say, okay, this, and this, and this is exactly what it should be. That just isn't how the tax code is set up. And I ran into it initially when we were setting up our business entity for Steinbach home selling team. And I was trying to figure out the right way to do it. Or actually, I don't know that I was trying to figure out the right way to do it. I was just trying to figure out how it's done. And by digging into that further, I discovered that there's about a million different ways to set up an entity, and they aren't necessarily right or wrong. It's like setting it up so that it works right for how you need it to operate, and then fitting it into the different tax guidelines to so that ideally that it's operating as advantageously as possible. So with the 1031, they say like kind, and like kind properties, and the like kind properties is it's essentially investment real estate or income producing real estate. So if I'm selling a single family home that I have rented out and buying another property, that property also needs to be, it needs to be real property, real estate, and then it needs to generate an income. And when they say generate an income, that could be like it could be farmland, it could be a piece of commercial real estate that you have leased out to to commercial tenants, or it could be another residential property, Airbnb, or a traditional long-term rental, or it could even be a share of an ownership in a commercial investment fund, or it can be you can buy a triple net lease property where a property's all rented out, and you're basically just buying this thing and you just collect a check every month. It's very broad in that way, and very defined that it needs to be an income producing property, and it or for investment purposes, and it needs to be real estate. So that's one of the basics. There's two types of exchanges, at least basically. There's a forward exchange and a reverse exchange. And typically what people do is they do what's called a forward exchange. And the forward exchange means that you sell your existing property, and then after that property closes, you have 45 days to choose, or they call it identify. So you have 45 days to identify your replacement property, and from the date of your relinquished property's closing, you have 180 days to close on that new property. So, and those are like the 45 and the 180. Those are like the very clear-cut guidelines of the 1031. And some of those numbers are very important. And when working with a qualified intermediary, which is who I've always worked with in dealing with a 1031 exchange, in working with them, they're going to be very strict, or very intentional about making sure that you are meeting up with those timelines. And because their goal is their job is to make sure that you're within the guidelines, and that you successfully accomplish this goal. You do pay a qualified intermediary a fee, and costs vary from, I've heard of people doing it for under $1,000 to, I'm sure some of them get very complex and are very expensive. I don't know about how much it can get up to, but the other way to do it is the second way of going about it is in a reverse exchange. And in a reverse exchange, the replacement property is acquired before you sell the relinquished property, and might be a little bit more applicable in today's market, where the right property, or finding a right property as a replacement, might be kind of hard to find. So depending on how specific your needs are, you may find that property first, and what you do is you purchase that other property in an entity through a qualified intermediary, and they put it in a LLC holding company, and then you then sell your relinquished property, and then that money goes to the qualified intermediary, and then they complete the transaction, and you quit claim deed it over to your entity, because it has to be the 1031 exchange. If you hold the property in your personal name, when you buy the next property, in order for the exchange to be completed, it needs to be in your name again, or the name of the entity that it was in prior to reselling that property. So that's something that that we've run into with our transactions, is that that part is it's just a sticking point, or something that I know our qualified intermediary has always been very
because he's married now,
very intentional about. Hey Rick, can you mute yourself?
Yeah.
Maybe. Anyway, so that's something that we've run into. There's also something that they call it a build to suit exchange, and that exchange is we did one of those with a property that we knew we were going to be selling a condo, and we're going to be 1031ing out of it and into another property. We were able to find another property and purchase it, do a rehab on it, and then sell the relinquished property, and then close on that replacement property with funds being transferred and no capital gain being realized. And with the 1031 exchange, the capital gain is one part of what you're deferring. The other part of what you're deferring is the depreciation recapture, and that can end up being a very significant portion of what you're doing, or the transaction. So in my first 1031 exchange, which was that reverse exchange that I was just talking about, we did that build to suit exchange, and so that property was the property that we were relinquishing was a condo, and a condo it's a little bit unique in that in a condo our basis on it, or we paid $465,000 for that condo, and when we purchased it, the land value associated with that condo, the tax record said that the land value was $20,000. Okay, and when you're depreciating a property, we took that $20,000 off of the $465,000 purchase price, so we had $445,000 of depreciable property. And the IRS lets you depreciate your properties. For residential properties, it's over a period of 27.5 years. So what that looks like with the calculator is a $445,000 depreciable total. Divide that by 27.5 years equals $16,181. Now, that amount, the $16,181, we were able to write off of our taxable income every year that we owned that property and ran it as a rental. So over the course of time, we started renting it we started renting it in 2010, and we sold it, I think it was in 2018. And so our depreciation was, gosh, times 8, was like we had depreciated $130,000 off on that property. And what when they say depreciation recapture, they are recapturing that amount that you've depreciated off of your income previously. So in that case, our gain wasn't significant, and in fact we actually lost $100,000 by selling that property. However, over the course that we'd owned it, the 13 years that we'd owned it, we paid down the principal pretty significantly. So we actually were taking some cash out of the property, but we weren't realizing a capital gain. However, the depreciation recapture was so significant that we basically would have owed like $10,000 or $15,000 had we not done a 1031 exchange. So because of this depreciation recapture, and depreciation recapture on any property, it doesn't go away. For me, on any of my properties, the depreciation recapture does not go away until I die. So that's important for some people because at some point in time, people look to be transitioning out of investment real estate, and knowing up front that you've got this depreciation recapture responsibility at some point in time in the future, it's something that people need to be planning for and be conscious of, so that you're going in with a strategy and being conscious about it and making decisions, so that if your end game ends up being just sell all your properties and live off of the lump sum of money that you've created, that's great. And yet you should know that you're going to have to pay the depreciation recapture. And in many cases, it's a significant amount of money. So most recently, I had one where a guy was, he really wanted to sell this mall that he owns, or like a strip mall, and his depreciation recapture was going to be like I don't know, $750,000 or something like that on a $2 or $3 million sale. So I mean, it was literally like 25% of the total money that he was going to be getting, he was going to have to pay back in depreciation recapture. I don't remember the specifics, but it was like that. So it was such a significant portion that he really, and he's still trying to figure out what he wants to do with it, but he's in a spot where it just wasn't making sense for him just to sell it and move on and like quote cash out. So that's something that people need to be conscious of. So maybe some real world examples is we currently have one
Pictures for
that we currently have one that we're doing on a property that we've owned for a couple years, sold it off, or are selling it, and are purchasing 2 other properties to replace it. The property that we got rid of is, or are getting rid of, we purchased it right as far as market timing. However, we also paid it off over the course of owning it, and now we actually have attached a couple lines of credit to it, so we're paying off a line of credit when we sell it. But in doing so, we're spreading it out, and now the two properties that we're purchasing are going to be cash flowing the same as what our relinquished property was cash flowing, and we're able to pay off some debt in the process too. So another part of the 1031 that is it's one of their criteria is that the replacement property needs to have a higher cost than not the sale price, but your net sale price of the property you're relinquishing. So, I mean, obviously you've got your, when you sell a property, you have some fees, maybe you're paying an agent something, maybe you've got some closing costs. Those are taken off the top. So if your property sells for, $215 and your net is $205, your next property that you're purchasing needs to have a cost of at least greater than $205,000. It can be so when you're selling that property for 205, netting you 205, and of that, maybe you've got $50,000 in cash and $155,000 in mortgage. You can take your $50,000 cash and you could split that between multiple properties. So you could go and buy two houses and then use mortgage financing to take on those other additional properties. It just combined needs to be of a greater value than what you're selling, or a greater cost than what you're selling. So what else am I thinking of here? What does anybody have any questions for where we are?
Darik, I got a quick question.
Yeah.
This is Rick. So if you're looking at a exclusion for taxes and everybody has a $250,000 per 2 years, how does that play into the deferred depreciation number? Is that a factor? Can you reduce the burden on the taxes by $250,000 every 2 years?
Thanks. So rather than answering that question specifically, let me go a little bit of a different way. So maybe we all know, and maybe not, as a owner occupant or a homestead property, I can sell my primary residence every 2 years and take up to a $250,000 gain as a single person, or a $500,000 gain as a married couple, and not pay any capital gains tax on it, as long as I've used that property as my primary residence for 2 out of the last 5 years. Okay, and that part is pretty clear. Now, if you have owned a property as a rental property, and so let's just say I own a house back here behind Whole Foods, and I've owned it for 10 years and have had it rented out, I could move into that property myself. And if I move into the property myself and live there for 2 years, it does wipe away the up to $250,000 or $500,000 as a married couple. It does wipe away that portion of the capital gain on that property. It does not reduce the depreciation recapture responsibility that we have against that property. And that's why I say, like, you could go, and so in my example, or with me, I could go and move into each one of our rental properties every 2 years and wipe away the capital gains tax on each one of those properties. and
You would be significantly reducing your standard of living.
right. I'd probably, like, my quality of marriage might be significantly reduced too. So I could do that. And the thing that wouldn't happen though, the thing that wouldn't happen is that I wouldn't escape that depreciation recapture. And again, I don't know. I mean, I maybe I make a bigger deal out of that than it needs to be. And yet I know in our experience, even though we didn't have a capital gain on the property because of that depreciation recapture, it still made selling it a loser for us unless we did a 1031 exchange. So, and that was specifically because it was a condo, because a great portion of the property was building value versus land value. And that's maybe something for everybody is on maybe on any of these houses in the west suburbs, like a $350,000 house in Minnetonka, if you were to buy that property today and look at the tax record on it, the land value on it is probably 225, and the house value is maybe 125 or something like that. And so if you take that $125,000 and depreciate that over 27 and a half years, like that's a much less significant portion of it than was the case on that condo that we sold. So that was that. So Rick, one more thing on your point is like a misconception I hear a lot though, is people thinking that the exclusion, the homestead exclusion, or that 2-year homestead exclusion, like you do actually have to move into the property and prove that you're living there. However, like anything else with the IRS, there's they have like their litmus test of criteria, and if you say you're living there, then like it's assumed that you are actually living there, and they will let you do that until they decide that they're going to audit you, and then you've got a whole lot of proving to do. So if as people were coming up upon that, and I've run into investors who are who are doing just what I talked about, where they're moving into each one of their properties every 2 years, and like, so this guy would move in. He owned like 5 or 6 houses in Hopkins, and he would move down the street in Hopkins to the next house. When he moved into the next house, he would go through, renovate the house, sell it after 2 years, and then move into the next house, so that he was constantly wiping away the capital gains that he had on those houses. And I mean, for him, that worked. I don't know. I mean, for me, I think it might make a little bit more sense if you were going to do that, that maybe you play the game a little bit differently, because to me, that's like it's an advanced strategy, higher level than like a common, U.S. citizen. Like they're not going to know about that. And like that might be a checkers example, whereas like if you go to a chess example, maybe you take all 5 of those properties, sell them all, and 1031 into something that's really big and nice, and then sell that after 2 years and wipe away your capital gain. I'm sorry. So if you did that, you go and take all 5 of those houses, go and purchase a really nice property. You do have to rent that property out, or they say like, I forget what the exact verbiage is, but it's like you have to attempt to get it rented, which to me means I think I'd probably want to make sure that I get it rented it out for a year, and then choose to move into it. You know, then you're wiping away the capital gains from all of those other houses, just not the depreciation recapture. So, and if you were doing that, that's great. You could do that, and you could live in that house for the rest of your life and not ever have to worry about depreciation recapture. And as long as your children didn't sell that house until after you died, they wouldn't have to pay the depreciation recapture.
So in proving the residency, is that 6 months and 1 day?
You
Or is
know,
that getting a little technical?
I mean,
So let's that's okay. I can look that up.
it's above my pay grade. I'll
Yeah.
say that.
Well, it's
Yeah.
above all of our pay grades. So
That's
that's why we
fair
look at Katie and Jen and our support to help us there. So let's talk about the 45 days and the 6 months, and then declaring the values. When you declare the properties that you want to replace the value of the disposed property, is that per dollar for dollar, or are you allowed to declare more than one properties in excess of that amount? You just have to have them declared. I've heard the number of 200%, whereas you may have 3 or 4 properties that you are earmarking and you are declaring them, and you're listing them with your qualified intermediary. But when it comes down to closing, you don't have to close all of those. You just have to hit that original target. Is that am I understanding that correctly?
Yes, you are with the properties that you identify, and that's what you're talking about, right?
Yes.
The replacement properties, yeah. And I haven't been in the situation where I've been prompted to name my properties or be in a position where I've needed that. And yet I know that comes up for people, and I can't speak to what that process looks like. I know that there is a process for that, and that your qualified intermediary will would guide you through that. And I have to assume that they have like a formalization process of that. Yeah, I said that right. So that like they're so that they have a like a paper trail to go back to in the event that you were audited, that they have that paper trail that says, okay, well, on December 5th, Rick notified us of these 5 properties, and lo and behold, then on March 3rd, he then purchased 2 of those 5 properties. And so the part that I'm unclear on with that is like as a realtor, like I just don't know how that really would end up being realistic. For most of our market-based conditions, like you're not going to know if you're going to be able to do it unless maybe that it is in more of like a commercial world where maybe you have letters of intent out on 3 or 4 properties or something like that.
I'll have to look into that a little bit more, but
Yeah.
that's all I got.
Yeah. The I think for me the curiosity started at when I was a Coldwell banker. Like, this is forever ago. We had this guy come in from Starker. Wendell Maltby was the guy's name, and he's like the Yoda of 1031 exchanges. At least he was in the Midwest for quite a while, and they actually called it a Starker exchange because that company was so involved in it. And I remembered him talking about 1031 exchanges at our meeting, and it really piqued my curiosity because it sounded like a way to game the system or to play by a unique set of rules. And it sounded to me like an opportunity that could be really advantageous to people. And for us, we haven't sold that many properties, and we have a couple 1031 exchanges going on right now. And the one that we did was a really successful in that we were able to transition out of a property that wasn't cash flowing. I mean, we were negative cash flowing on the property we were relinquished. We were negative cash flowing like $550 a month. And the property that we bought, I think we've been like a $400 a month positive cash flow on that. So it's almost $1,000 a month swing on that part of the transaction, swapping one out for the other. Not only that, we were able to defer that depreciation, defer the capital gain. And then the next part that was super cool is, so we did our rehab project, and we bought call it a $250,000 house, and then I think we put like $70,000 into it in Orono. And then so the property we created was then worth $400,000, but we were only into it for $320,000. So we created instant equity in that property. And we then, when we bought it, we refinanced and we pulled out like $30,000 of cash from the property that's completely tax-free. And that's tax-free. That's not tax-deferred. That's tax-free, because the IRS views a refinance as taking on debt. They don't view it as earning income. So we were able to take out to get $30,000 cash in our hands, and we were now $1,000 a month ahead on running a rental property, which was a huge deal for us. And I mean, that property that we relinquished was like that was our 10-year barnacle that like we just couldn't get rid of that thing. So and it didn't make any sense for us to sell it or whatever, and it was underwater for a long time. So that was pretty significant for us. The way it ended up working out, I was really shocked that it ended up working as smoothly as it did, even though it was it seemed pretty complex, but it ended up working out pretty well. With the one that we're currently doing, I guess I don't anticipate any problems coming up on it. We close on our relinquished property on November 16th. We closed on one of our replacement properties 2 Fridays ago, and we're currently in a rehab on that property, and then we'll acquire one other property to be determined here in the next 45 days, I guess, or 45 days from November 15th, 16th. So we'll have to figure that out. But in that scenario, what I've determined, or at least what I think, is that I think we will end up cash flowing more than we currently made, and we will end up, after we end up refinancing on the back end, we will end up with cash in our pockets from that whole transaction, and increasing our equity across multiple properties too, because that's kind of part of the leverage system we're doing with our rehab that we're doing on the property. So it ends up being a pretty cool transaction. So what other questions do you guys have?
Derek, I have a quick story if we got time here.
Yeah.
So a real life scenario I was involved in. So if you're not confused, I'll get you a little bit confused here. My partners owned a parking ramp in St. Paul, and we ended up selling it to the government, city of St. Paul. And what that is, it's something called a 1033. So think of everything that the 1031 has, but extend the timelines and get a lot of leeway. So we didn't end up finding a new property and closing till 2 years after we closed on that parking ramp.
Wow.
And so we sold the parking ramp for a little over $8 million, and the property that then they brought me on as a partner, and the property that we bought was, I think we paid 10.3 for it or something. So we needed to come up with more debt and more equity. So if you ever run into a scenario that whatever government entity wants to buy your property, it turns out to be a good deal because we still had the 45, 180, but then once the 180 came up and we didn't have a new property, and we asked for extensions for 2 years, and they gave it to us. So my partners didn't want to pay their taxes. Obviously, they wanted to do a 1031, but this was in the heart of the recession. So we ended up finding a property, but it was a couple $1 million more than they sold the ramp for. So if you run into a government deal, they're not always bad because they actually give you a lot of leeway because they really wanted to close on the ramp and they were willing to give us some wiggle room. So kind of a side note of what you're talking about, but
Yeah.
They're called a 1033.
That's interesting. You know, I don't know, like I've heard of that before, and I don't remember if I heard of it through you talking about it, or if it was another another person who was talking about some experience like that. And I mean, that's pretty crazy. I guess, you know, it's like anything else. Like, it depends. If you got the right person buying your property, there's all sorts of things that can go right. So that's awesome. Beth, you had a question.
No, I just wanted to sit in because I'm at the point where we have investors who are throwing out, well, what about a 1031? And Andy knows more about it than I do. So I just wanted to get a little bit more information.
Yeah. You know, so I think for our purpose as, you know, as agents, I think the best thing that we can do as agents is to like hand off information and get our clients connected with people who do have the right answers. And like with any of it, I mean, consulting their accountant is absolutely valuable. And if by chance they don't get the answer that makes sense or that they want from their accountant, I think I would encourage them to talk to a qualified intermediary or somebody else who is very familiar with exchanges, and especially before they've got a property under contract, or you know, before they've got it on or have closed on it or something like that. It's so important for them just to talk to somebody else. And you know, when you're selling a property, if you didn't know if you wanted to do a 1031 and yet had this closing coming up on you, it wouldn't be any problem to have the money sent to a qualified intermediary, and then after the fact decide, you know what, hey, we don't want to do the 1031, because you can reverse that part of the process, but you at least I've been told that it's very difficult for for them, like they don't ever want the money to touch your hands or your bank account. They want the money to be completely completely off limits and go go to the qualified intermediary, and they've got their trust accounts or whatever. And I think that's, at least everything our accountant has told us has been that that's a very important part of it. So and making sure that your investors too at least understand that basic concept that they're deferring paying the capital gain and deferring paying that depreciation recapture. I've had a couple people over the years who have had, like, I don't know, I guess I would call them unique circumstances. One of them, he owned like a triplex in Minneapolis and originally bought it for like, I want to say bought it for like $30,000 and then sold it for like 300. And so he had a significant capital gain on it, but the depreciation recapture wasn't significant on that because that original purchase price was pretty low. So it just wasn't that significant. And then he had 1031 that into a duplex in Minnetonka. And this duplex in Minnetonka, he had all that equity in, and was then, they moved into it as their primary residence and was going to use the capital or the homestead exclusion. And it ended up being kind of a clunky deal because because it was a duplex, they could only use that homestead exclusion for half of the property. So in doing it, he was going to have to pay basically half of the capital gain tax on that he would have. And in his case, he didn't end up even using a 1031 exchange again because he'd already done that homestead exclusion, but he ended up getting socked pretty good on taxes for the previously realized or previously deferred capital gain on that duplex. And I mean, kind of a unique circumstance. And it seems like every time I talk to people, like everyone's circumstance, because everybody's doing something different all the time, like these circumstances end up being like very different all the time. And that's where, like, I use this guy Jeff Peterson at Commercial Partners Exchange in Minneapolis, and the guy, I don't know how he keeps track of it all, but he seems to, he's like, I never throw anything at him that he's not heard of or seen or something like that. So it's pretty cool. Anything else? No? Awesome. Thanks, guys. Come talk to me or shoot me an email or give me a call or whatever if you have questions that are more specific or whatever, okay? All right. Have a good one. Thanks. Bye-bye.
Thanks, Darik.
Yep. Bye-bye.